Our next session encompasses managing cost for dynamic growth. And when we speak of cost, very often we think of contraction, not growth. But managing costs correctly, while it does involve cutting the extraneous fat, also involves allocating available resources to the right areas to create value and growth. Areas that, as we noted in our previous panel discussion, are very essential to our growth and present many, many opportunities. So I'd like to invite on stage to discuss this timely topic our panelists, Mr. A.N. Raman, past President SAFA and Advisory Council member of CMA, Mr. Raj Prabhu Rajakulendran, lead economist at Verite Research, Mr. Asim Barkava, Senior Vice President, Finance, Lanka IOC, Ms. Sanjeevani Amarasinghe, CFO, Lanka Tiles PLC, Mr. Channa Gunawardena, Director and Chief Executive Officer, Dankotua Porcelain PLC, and our co-chairman and chairman, Mr. Asanga Vimalaratna, Council Member, CMA Sri Lanka, and Chairman Mr. Ruchira Pereira, Council Member and Technical Committee Member of CMA SP. With our panelists in place, I invite our chairperson to take control of the session, Mr. Ruchira Pereira.
So good evening, everyone. I know some of them are outside, but hoping that they will join. I know we don't have that much of time. We have to finish this by 5:30 p.m. So this session is all about managing cost for dynamic growth. So today we have two speakers, joined by three panelists. Myself, along with my co-chair, Mr. Asanga, will conduct this session. So talking about this topic, in today's rapidly changing world, we know companies are facing so many issues. Not only there are peer pressures, competitive pressures, that there are challenges from technology. So we would like to know from our speakers and panelists the challenges that they are facing when they are achieving sustainable growth, and also what kind of cost management strategies that they can adopt, and what kind of cost management strategies that they can share with us today in this forum so that we can take them forward. So without taking much of your time, because since time is limited, now let me invite our first speaker for the day, Mr. Raman. Mr. A.N. Raman, who's a friend of Sri Lanka, and he will be talking about managing cost for growth strategy with sustainability. Over to you, Mr. Raman.
Wish you all a very good evening. I am extremely thankful to Professor Vatawala for this wonderful opportunity which he has been giving to me almost in every National Management Accounting Conference. And I do enjoy in working up with a good presentation to the extent I have insights on each topic he has been giving me, and come and share some of the ideas I have with the wonderful audience I always get in Sri Lanka. Let me begin this session with the end in mind. And what is that end in mind? Let's remember again now very strongly that we are speaking on the platform of Cost and Management Accountants, CMA. So that means as a CMA, our domain of competency has a differentiation. It's not a normal accountant. It is a cost and management accountant. We do have a set of concepts which are unique to us, techniques which are uniquely deployed by the cost and management accountants, ideas, standards which should be issued as a nation progresses towards cost efficiencies, And all these put together constitute the competency of the domain of cost and management accounting, which is differentiated from the other accountants. Applying the lens or the optics from that domain, how do we align with this topic? Where we need to contribute to navigating with stability a dynamic growth of our country. How do we as cost and management accountants participate in that? That is a big question which need to keep lurking in our mind always, because when we speak of this topic in the context of financial accounting or pure sustainability reporting or things like that, still we are not touching on the core of the cost and management accounting profession. I intend to do that in my presentation and give you an idea how to align, how to do that. But to achieve that, let me first have to piece together the missing links. And what is that? Before I go ahead with the presentation, let me piece together those missing links. The first is whether Sri Lanka or India or any other country today which is not in either the China bloc or the USA bloc, of course other blocs have withered away, we are all in the race of having a competitive edge and trying to become a developed nation. We are all emerging nations, but we are trying to become a developed nation. In doing so, every country has its own challenges. So today morning, the first session, we spoke a lot about the geopolitical issues, the debt traps, the IMF, repeated visits to IMF, lots of financial obligations for countries. We spoke so many things. But in an organization, when we work in the context of running a business model, can we point out to that and then say we can't function? Just impossible. Whichever be the country other than these two major countries which I spoke, will have to compulsorily function in the today's context of the geopolitical situation. Only thing is, we need to read that and prepare ourselves suitably. So given a debt position at a macro level, given a geopolitical situation, how do my country, how as a country, I align myself along with my own corporate and individual citizens, how do I align with that? This is exactly where we get into, from 30,000 feet of geopolitics, debt trap, etc., you drop down to 20,000 feet and then see where all there could be competitive advantages for the country. And in a sustainability-driven environment, how do we pick and choose certain sectors and push the country's private and public sector towards that? Now, this is exactly where I would like to know more from you in the future days, where exactly this economic planning happens. The reason why I am telling this is, if there is a pool of economic planning, a bank of economic planning or an entity of an economic planning which tells Sri Lanka is going to have the competitive advantages in industry 1 or sector 1, sector 2, sector 3, service sector 1, 2, 3, and we are going to have macro country level planning to push the competency thinking in these economies. This is how the infrastructure is going to be aligned, and these are all the incentives being planned. Then the individual companies at 10,000 feet would get aligned with that. This perhaps requires a lot of focus. That is exactly where the CMAs also can participate more. You saw one very simple example of today, the seashores, the beaches topic, which was there in the earlier session. We would like to promote tourism, and within tourism, there is a sub-product called beaches and resorts, which we have got specialization, but we have got competing countries. India is competing, perhaps some other countries also will be competing, how there should be a differentiated beach. So then we get into the processes of things like certification, but how the government can create an infrastructure for promoting that particular sector in an institutionalized way. When any company or in any country, when the government starts incentive planning like this, and pushes what I call in CMA as a value chain thinking where a competitive advantage for your country exists. That is exactly where you can drop this 20,000 feet to a 10,000 feet of an individual company level. So when I do strategic planning as a CMA in the corporate sector and look out at the opportunities of a country level competitive advantage, to harness the resources available and look at the global markets, because we also said in the first session, we are not having a demographic advantage. So we need to look at the global markets. So this is how I connect with all the session 1 and session 2 topics. So the strategic planning as a CMA tool, a very important CMA technique, a very important CMA competency comes into foreplay when I in touch with a major country level planning body which tells me this is what is done in the form of Niti Aayog in India, where the Niti Aayog as an institution releases document as to where all the competitive advantages are there for India and how we can plan sectoral initiatives by the corporate sector, the private sector. But the planning for the country as a whole is done by one agency. So if there is an agency which plans for beaches and other sorts of products under tourism and announces incentives and schemes, that comes in the lap of a typical CMA doing a strategic planning for a tourism company in Sri Lanka. He gets into all this sort of topics. And this is how the strategic planning of a particular body, where a CMA sits as a cost and management accountant, he starts with his work of strategic planning as a key important function. This is where my presentation starts. So now look at this graph, which is there on the other side of the screen. Look at this graph. Typically, when organizations grow initially, they gather their own ideas, the growth phase, everything comes fast. Because of the success, certain ideas get into our mind. When the stability of an organization phase comes, the ideas are frozen. You are very happy with the success. You always think what works now will always work forever. But when opportunities come, third phase of an organizational growth, two types of reaction can come. A new opportunity has come, like for example, in this situation, I am seeing there is, in this case, the beaches example. I see beach as an important growth segment, but there is something relating to certification. Some differentiated beaches need to be created. I take the challenge, renew myself, bring in new systems, ideas, new tools and concepts, then I grow. If I don't do that, I deny, I argue, I challenge, I refuse to accept, then the decline starts. So once the decline starts, again there is a tough process of coming up. Not to allow this decline and go on the renewal path is the role of leadership, and that is exactly where a typical CMA competency with the ideas of strategic planning in the mind renews his organization at a leadership level by bringing in more ideas. A typical example in this case is what the tourism beach resort, what he was telling. Yet another example is, which I can quote, which I am aware of, is once upon a time the type of advantage we had as far as garments are concerned. Sri Lanka was called as the house of tailoring for the whole world. But somewhere along the line, the competitive advantage slipped for some other nations. So investments started moving into countries like, for example, last 3-4 years to Bangladesh or Vietnam or Thailand or Indonesia. Not only Sri Lanka, but even countries like India lost that competitive advantage in the Bangladesh garment sector. But something was happening in the marketplace which was not read in advance. These things come in this decline if you don't capture what needs to be renewed in an organization. So this participation in the strategy building of an organization is a very, very important leadership role of CMA. If that doesn't happen, then the CMA as a leader fails in that organization. How that failure exactly happens, you can have a feel of what different types of organizations are there. If an organization you see on the next slide on the lower side, It is the lower side, it is an organization where the turnover is also not growing, your profitability is also it's not growing, and that is exactly what Porter calls in the theory of stuck in the middle. There are organizations which are on the top right side, which are extremely robust. They have a very high turnover, high profitability, and these organizations become leaders through what is called as a cost leadership strategy. The organizations on the left top, they are low in terms of turnover, but very high in terms of profitability. That means they have mastered the technology. They are getting highly premium made products, but their volume is low. These are the three types of organizations. As a CMA, in managing the cost and the strategy of the organization, it's very important you do not fall in the bottom. Your reading of the markets and competitors and your positioning should be in such a way you do not fall in the bottom, either lay on the right side or on the left side at the top. Best thing is it's full integration. So this full integration comes by adopting any of these three strategies. So if you see in the screen, you find there are three practices. One, I can practice market segmentation, where I can prefer to operate in a market by understanding the market segments. Another case is cost leadership, and the third is what is called the differentiation strategy. How these things can be applied in the context of what we spoke. We are in the business of beach resorts. How do I differentiate Sri Lanka and try to may not be a premium immediately, but there should be a differentiation strategy and brand equity should be built on that. This is exactly where we spoke of ideas of certification of beaches. In addition to that, if you still want a better differentiation, we have to come out with an imaginative differentiation of what else can be built in those beaches which India has not done, or Vietnam has not done, or Australia has not done. You bring in those differentiated features and capture a market. But only thing is, it could be on a narrow volume, but only thing is margin could be high. You as a careful player in tourism, you may be in one company which is going to practice differentiation. Or you may be in another company, you are not going into the different type of beaches, a plain vanilla beach, but my market segmentation is for large volume. I want to play on the volumes. So this thinking in terms of how the company should strategize. Am I going to segment the market and focus on the markets? Am I going to be in the premium category of cost leadership, or should I be in the premium of the features? These discussions go into a typical CMA as a major competency when you do the strategic planning. Yet another example we heard today came from Haycarb. I have a lot of sustainability practices, but so far the market was not recognizing the premium. But what she said at the end of the day, the landscape is changing. So as a CMA strategy in their organization, they may be segmenting the markets into those markets which ask for that premium and those markets which do not ask for that premium. As a strategy, they may decide to exit the non-premium markets and operate on a premium market with a differentiated product. These things should be backed up with a very strong value understanding, value creation, value proposition required from the customer side, and what is your cost structure on your side. So how does it matter? At a financial accounting level, it doesn't matter. But in case if you have two beaches, one beach somewhere near Hambantota and another beach near Colombo, the Colombo beach is a premium beach, whereas Hambantota is an ordinary beach. In a typical cost accounting organized, which is for managerial costing framework, would recognize these as two sub-entities of one entity. What is the cost of maintaining per square of Hambantota beach for getting a higher level premium versus what is the cost of maintaining the beach or the premium beach near Colombo? How the cost structures are connected with the premium being offered in the market will constitute the base of this sort of thinking. And that brings us to the topic of integrated cost management as a competency which sits in the heart of this sort of multiple strategies to manage growth with sustainability. Such sort of a pattern can take two routes, typically in manufacturing organizations or in non-manufacturing organizations. The type of strategy what I spoke to you can take two routes. The route on the right side is incremental, like what we typically do on Excel. This year turnover, add 5% growth next year, and again add another 5% next year, a linear pathway. But the one strategy on the left is what is called a breakthrough. Today, countries like Sri Lanka or India or South Asian countries, we require breakthrough in thinking. There cannot be an incremental rate of growth. What we need to do so that the typical exchange problem where repayments are going to start in 3 years, that's what the morning speaker said. If it's going to come in 3 years, we will not have enough remittances or reserves in our hand. So we need breakthrough in our approach. How do we do all these things in such a way there is a rapid growth? And that is explained on the left side of the diagram, where you have a breakthrough in the strategic thinking. You look at the drivers of growth at the breakthrough stage. Look at the ideas which can bring in that sort of quantum jump in our growth and profitability. Evaluate those ideas through the cost and management accounting tools and recommend to the management we take this breakthrough strategy path. Because of this, there is a different premium, different returns which are available. Now, this is done in the form of a good cost management architecture, which is a competency of a cost and management accounting. So in cost and management accounting, strategy comes as a central theme in the cost management. What strategy you are adopting, like in this typical beach case, a sustainable strategy for a Colombo beach, not so sustainable, but a vanilla strategy for a vanilla market. So you have got two offerings and two pricing. So what is the pricing methodology? The second part, what is the pricing methodology for multiple product differentiation we have, and what market segments we are operating? What is the business model? Which are all the market segments we are there? So we should get super profit from market segment A, ordinary profit from market segment B. These are the topics which constitute the heart of cost management, which is placed in relation to a typical value creation proposition aligned with the country level strategy, so that you maintain your competitive advantage. If you don't constantly do that in a breakthrough strategy, what happens is, like which happened in the garments case, it may be there for 3 or 4 years, but suddenly it shifts to Bangladesh. But even Bangladesh is now again losing it. If you take the last 2 to 3 years, the investments in the textiles have significantly gone to Vietnam. Whatever the figures today you had in the morning, that FDI is going maximum to Vietnam, Thailand, last 3 years is mainly in cases like the garment and automobile industry. In fact, suddenly Egypt also as a country came for getting more FDIs in the textile industry. Why? They have got a local advantage called Egyptian long staple cotton. They had cotton but not spinning. So now they are adding the spinning, and the FDIs are going in terms of spinning. So the competitive advantage of Egypt as a nation is availability of a fiber. Now when the profit will now shift again from Vietnam and Bangladesh partly to Egypt. So this is how globally the investments will be moving here and there, trying to get the maximum returns from the investors. So we as cost and management accountants should be constantly on guard to understand what is the value chain, what is the product profitability, how do we keep positioning ourselves in a global economic war of always trying to have a competitive advantage. Now I will wind up this presentation by giving you an example of how we are doing this in India, which is again in the green area as far as the hydrogen is concerned, which is 10 to 15 years thinking. You are seeing on the screen a wonderful diagram of what is called a green hydrogen value chain. It is like what the greening issue topic which came in the previous session. In the ESG, E is more important today, and any green topic gets maximum investment. And today, if you look from a country level thinking, green hydrogen is a very, very important futuristic product. And what is green hydrogen? Blue hydrogen and gray hydrogen are not environmental friendly, which is there on the bottom. Whereas green hydrogen is environment friendly. Quickly, what is the difference between the two? When you burn the fossilized fuels, like it can be a coal or it can be oil, what happens that in that burning process, hydrogen gets generated. You may use the fuel for many purposes, but once the hydrogen gets generated, if the hydrogen is let off into the air, it is not a green hydrogen and it is also called a blue hydrogen. But when that hydrogen is trapped and reused subsequently, it becomes a gray hydrogen. But again in this case, you are burning a fossilized fuel and because of that it is not a green hydrogen. Now what is the world level thinking, what is happening? I am going back to again 30,000 feet. At a global level, there is a race for looking at how we can generate green hydrogen. And how do we do that? I can use a natural resource like a seawater or a desalinated water. So water, as we all know, is H2O. So when I perform an electrolysis operation or a technology on this desalinated water, hydrogen gets emanated. If this hydrogen, after certain treatment, it is bottled, it can be distributed. Wherever there is a naphtha and gas and all these LPGs are used as fuel, if this particular hydrogen is used, it becomes a net zero. If this is done, what happens? Over a period of time, let's say 20 years or 30 years, the dependence on this oil, which is coming from the Gulf region, will be gradually, it will go down. It will come to a point where you shift to hydrogen as a base, which is not going to pollute the environment. This is basically the concept. But globally, there is a race. Why? Countries like Saudi Arabia would know after 30 years and 40 years, if the fuel is gone, their competitive advantage is lost. I am talking again at the 30,000 feet level. So Saudi Arabia is now on the forefront of putting up a hydrogen-based power generation plant, the world's first plant which is coming up. But that requires a terrific technology. And what is that technology? Electrolysis technology, very few have in that world, which comes in the second part, where you find next to the green, that electrolysis technology, small diagram is there. You need an electrolysis technology. But once hydrogen is generated and it is bottled and kept in huge tanks, it can be sent to a residential segment, market segment, for being used as a fuel in the house. It can be sent to factories. LPG-based furnaces or gas furnaces can all become hydrogen-fired furnaces, completely going green in the factories, or where the furnaces are operating, it can go green. Or if it can be pumped into automobiles, where the internal combustion engines are today going into the electric. Those internal combustion engines using diesel or petrol or LPG, if they change into hydrogen, then automobile companies, all the products are again green because they are not polluting the environment. So now, if you look at this, research is required in BARC, in a technology center. There is a Baba Atomic Research Center in India, in Mumbai, which is doing that. It should come up with a effective research in terms of proven technology. Internal combustion engine in an automobile is needed. So you need a research into engine making. A company like Ashok Leyland or Tata or Daimler, they must be coming up with the technology. But a visualization at a country level, like a planning institute or an agency should be there in a country which tells in another 20 to 30 years, India will go net zero and we will be a green hydrogen capital of the world. So hey, you IITs, technology institutes, you work on electrolysis. Automobile companies like Ashok Leyland and Telco, you work on how to come up with internal combustion engines in another 10 years. And this setup, how to get into a coal, instead of a coal-fired furnace, how to develop an LPG-fired furnace in your factories to generate power. I need a smaller technology for that. So the government at this stage of life cycle pushes technology. So now there is a company working on that technology research. Another company works on internal combustion engine technology. At this stage of this economic planning, such companies come up. But what happens once gradually this infrastructure, like today's petrol bunks, you need hydrogen petrol bunk. not petrol, hydrogen bunk for vehicles to go and tap. You need to think through for another 20 years how to develop the nation's hydrogen supply network for automobile sector. This country level infrastructure, the 30,000 feet work of the government. At the same time, the government will push individual companies, 10,000 feet level, a company in Ashok Leyland, a company somewhere in an atomic research center, specializing in that, investing in technology. They will look at all this and start putting money in that, supported by the investors, because it's a availability to green funding. They are working on a green funding, and the returns could be quite huge, because green hydrogen is going to be a reality. Who is going to do first is the race. But once this race is completed, look at the economic planning. In a span of 30 years, the oil budget, which is burning 30 to 40% hole in the government's national level funding, that is released for other sectors. Because my budget on importing oil from more and more of oil from the Gulf region, or it can be from Russia or Nigeria, that drops heavily if this green hydrogen project comes. No, this is all at 30,000, 20,000, 10,000.
Excuse me. Would you be able to finish it within 2
1
minutes?
minute.
Okay, 1 minute.
So how do I CMA connect with this? Because all these stars which have come here, they are all the CMA techniques of this value chain. If you take the one in this case, the beginning, what is called as a target costing. The government cannot put this into operation unless the whole hydrogen is available at, let's say, $1 per kg or one bottle or one container. Equivalent today, the public is paying, let's say, $2 or $5. Now, the government is setting a target price of one. Unless I make it at $1, it cannot be successful. So now I get into a technique called target costing. So this target costing technique is a CMA technique for which all the companies will have to use that as a target costing to make that available. Now the government is giving a target of $1, isn't it? So how do I monitor the cost structure? All the companies in the value chain should come within that $1. I get into what is called a societal costing, where bodies like CMA issues cost accounting standards showing the cost of participating in the value chain, which can add up to $1. If it is not happening, the government comes down on monitoring and using that societal costing information for administering the strategy. At each of these stages, I don't want to expand. All these yellow stars, what you see, is a hidden CMA concepts in all this value chain. This is not financial accounting. This is the CMA costing techniques which form a part of the management accounting framework which has been right now issued in our ICMA Sri Lanka. So these sort of frameworks and cost accounting management and techniques at 2,000 feet level or 3,000 feet level gets aligned with the company level strategy, which in turn aligns with the economic planning and which in turn aligns with the sustainable development goals globally. This is how the alignment of our profession for managing the cost along with growth and sustainability will have to be driven with leadership and passion in countries like that of ours. For the paucity of time, I am not able to proceed further in granular level, but broadly this is the concept I wanted to share with all of you. Thank you, friends.
Thank you very much, Mr. Raman. I forgot to tell you earlier, Mr. Raman has been the past president of South Asian Federation of Accountants, SAFA, and also he is an advisory council member of CMA, in addition to being a member of CMA-SB. Thank you very much, sir, for your insights. So now I would like to invite Mr. Raj Prabhu Rajakulendran, lead economist in Verite Research, and he will be discussing on optimizing government expenditure and managing fiscal risk with transparency and accountability. Over to you.
First of all, I would like to thank CMA for inviting me. I know I'm one of the last speakers here, so I'll keep it short. And yeah, first of all, thank you for listening. My talk is going to be slightly different. I would also like to talk about government expenditure. I am also an accountant turned economist, so now I am no longer an accountant, so I feel a little bit unprepared. But my whole talk here is going to be around two beliefs that I have. One is that economic policies should not be left to economists. Economic policies need to have more than just economists. And two is that you don't operate on self-interest. If everyone operates on self-interest, we will result in suboptimal outcomes. So at the end of my talk, I would like to have convinced at least some of you all to think beyond companies and corporates and also to be involved in the government policy making per se. And we've left the government to do its job, and that has led to the economic crisis. We want more private sector involvement in the policy making, and maybe I will demonstrate why, and I'll also demonstrate how that works. So maybe if I can go to my presentation here. First of all, the whole idea that we've been talking about dynamic growth, right? Actually, Sri Lanka is lagging behind its peers. In all over the world, if you look at IMF numbers, it's the emerging and developing Asia that's growing. That's the red line you see. So generally, world growth is fueled by Asia and especially developing and emerging Asia. And if you look at South Asia, like all this time, the red line, that is Sri Lanka, has always been above Bangladesh and India. We've boasted that, look, we have a great GDP per capita, we have great human development indexes, and all of that. But what's surprising is that for the future, by 2032, if we follow the IMF pathway, Bangladesh and India is going to take over Sri Lanka in terms of GDP per capita. So the one thing we were very proud of is being taken over if we follow the IMF pathway. It's because the growth is quite muted, and it's also that the crisis has really affected us in a deeper way than we think it is. So that's just to set the frame on how we think about growth and expenditure. So the next thing that might come to you is to say, oh, you are going to grow, you might have to spend. And academic research tells you that to grow, you have to spend more. Doesn't mean you spend on the useless things, but general good spending will mean that you can grow. So that leads to my second section on why is understanding expenditure very important. Because on the surface, there are a lot of positives that we keep claiming that when you delve into the nitty-gritties, and this is where my thankful accounting training comes into place, where you understand how these numbers are being achieved. You can, on the surface, you can window dress a lot of things. So for example, an economic concept, which I hope many people are familiar, and for the ones who are not, is something called the primary surplus. And that's something the IMF and the government has been very, very focused on achieving. And what that is basically your total revenue minus your expenditure without interest cost. So that is primary expenditure and primary balance. And we have to achieve a surplus. That is, your revenue has to be greater than your primary surplus. It was very hard for Sri Lanka to achieve, and we've achieved it for the first time in 2023. Good news, right? Maybe I will change your mind in the next slide. So how does this work is that in 2022, you had a huge primary deficit of 895 billion. So that you started off at a very bad base because of all the crisis. But then we introduced a lot of new taxes and revenue measures, and that meant your revenue came up and your revenue increased. So then you had a positive primary balance of 167 billion. But what happens is that as you get more revenue, you also spend more expenditure. So when you spend more, you increase your recurrent expenditure, and that meant that your primary balance came to a deficit of 123 billion. You also increased capital expenditure. We restarted a lot of our projects in that year, which meant that then your primary deficit actually came to 321 billion. So if we performed government operations as we usually did, we would have had a primary deficit of 321 billion. But we didn't. We reported a positive primary surplus. So the question is, where did that money come from? The money actually came in something that the government uses in its accounting system called reduction in net lending. And that basically, because your net lending reduced, you considered that as an expenditure reduction and said you have a primary surplus. So that's how we came with this primary surplus of 173 billion in 2023. So now the question is, what is this reduction in net lending? It's basically last year, that is in 2022, the government gave a lot of loans to CPC, the Ceylon Petroleum Corporation, and all of them. And in 2023, 1 year later, these corporations paid us back. And when these corporations pay us back, we consider, the government books considers it as almost a revenue. And that's an additional income, so that is also recorded. So the accounting standards, I'm not sure how it applies, but the question is, you can't continue this in the future. This is a one-off thing. Like one year, the government, the CPC will repay you huge chunks because you took loans from them earlier. Now the question is, can you sustain this primary surplus? And you will only realize this when you look at the expenditure numbers. So that begs the question that if I have to grow, I need to spend more. But the question is, where do I spend? And that's the whole idea of what we're talking now, is how do we optimize government expenditure? The second thing is that the government also understands that optimizing expenditure is very important. So which is why they introduced something called fiscal rules. The government themselves put rules to control expenditure. But the problem is that we are great at putting rules, but we don't follow them. Classic example is the fiscal rules that was put in 2003, that is still to effect, and that will change tomorrow when we vote on this new public finance management bill, but today this is what the rule is. It basically says that your deficit cannot be more than 5%. And what I'm showing now is that from 1977, we have never followed the rule. So we can have great rules, but we don't follow them. The problem is that nobody questions. And if you don't follow accounting standards, I'm sure the auditors will question. But for the government, who holds them accountable? So maybe that's, again, why I want to bring this up, is that think tanks and economists here can do very little. And I have been a constant advocate for getting more accountants and lawyers into my firm as well. But I think we should also bring in the accountants to say, look here, you have set guidelines for yourselves, and you're not following them. That's a problem. And highlighting this is very important, because now in the new public finance management bill, they have basically said, oh, we are going to remove this rule, we are going to bring in a new rule. And that is basically to control primary expenditure at 13%. And what this tells you is that only 8 countries in the world spend less than 13%, and that's the limit that we're putting ourselves. So basically, Sri Lanka is restricting future governments from spending beyond 13% of GDP. And if you don't spend, you're not going to grow. What we're showing is Pakistan, Vietnam, Malaysia, India, countries that we know have less GDP per capita, spend more to achieve their GDP per capita. And Sri Lanka restricting itself to a very low limit would mean that it's very hard to grow. Because if you don't spend, and if you're crowding out private investments, then it makes it difficult to grow. So then the question comes is, if there is nobody holding people accountable, how do you go about it? And even today, or tomorrow rather, the government is going to vote on this. And what we realize is that no country in the world has a rule like this. So usually countries have like a budget balance rule, countries have like a debt rule. Only 10 countries in the world have a primary expenditure rule. And because nobody holds the government accountable on its stuff, I think these bills get passed. So this is where I think, again, the accounting fraternity comes in to say, I'm going to hold them accountable. The reason why all of this is important is that it's very hard to grow for the government when you have a higher interest cost burden. Majority of Sri Lanka's expenditure doesn't go for health, doesn't go for education. Sri Lanka is one of the lowest education spending in the world. It goes for interest. So like you see here, in 2023, most of the revenue is just eaten up by the red bars. Like the interest cost is just eating up all of the revenue. So no matter how much tax you pay, it goes for interest cost. So you have very little revenue that's left to spend on anything, and that needs to be optimized really well. And this is just to put things into perspective, where like in 2022, Sri Lanka had the highest interest cost to revenue in the world. In other words, that means for every 100 rupees that you put in as taxes, 80 rupees goes for interest cost. And as accountants would know that if you're running a company like this, you are bankrupt. And the problem is that Sri Lanka is running the country like this. And no matter how hard, and the only way to correct this is to hold executives accountable and to come up and say, we are scrutinizing you. And I'm going to move on to show case studies where Verity as a think tank, mostly with economists and very little accountants, comes out and says, look here, we are going to hold you accountable. Things actually change. So it doesn't mean that, oh, like what can I do? I'm just a private sector employee. Not really. Like I think as small as your efforts might seem to you, there is a lot to change when you come out and say stuff like this. And let me sort of rush to those slides. First case study is on budget promises. So one thing that Verity does and Verity continues to do is to track the budget. The budget constantly says, look here, we are going to do this, we are going to have an AI university, we are going to have a new airport, we are going to have a lot of other things, right? But a budget is not a manifesto. It's not where you promise stuff. It's where you say, you put money where your mouth is, and you say that this is what I'm going to do, this is how much money I'm going to put in, and this is how I'm going to implement. And what we've realized is that the government is not, nobody asks the government this, the government is not transparent on its budget allocations or its budget expenditure until Verity started doing it. And what we see here is that we started this quite early as well, but I just have the 3 years. 2021, we got information for 53% of the proposals. In 2022, because it was an interim budget, the government was also not too open with giving us information. In 2023, we had the highest level of transparency. That means that we were able to get information through the Right to Information Act and all of these tools available to get the government to disclose this information on progress of the budget. And that is a huge achievement. Because Verity started filing RTIs, we were quite open about the non-transparency, the transparency improves. But then we also find that only 16% of the budget was fulfilled. So I can tell you 100 things, I only fulfill 16 of them. And that's how the budget promises work. So then the second order effect is to question, okay, how do we ensure better execution of the budget? But you realize that the budget is not being properly executed and how bad it is only when there is transparency. So that kind of links my talk to say you can only optimize expenditure when there is transparency on the expenditure itself. The second example is on foreign interest cost. And this is also an interesting case study that we did at Verity. And what we realized is that historically, from 2013 to 2018 at least, the government will always say that the foreign interest cost is very low. Like in 2016, for example, the government claimed in the budget that the foreign interest cost is only 79 billion. But turns out the actual is actually 127 billion. And then we had this puzzle. We were like, you can't fail to project interest costs because you have a loan stock, and that is going to be your majority of your interest costs. So you can really project that quite well. Why is this a problem? And we raised this out. We had press releases and all of it. And we actually went to the Committee of Public Finance. At that time, Mr. Sumandran was the chairman. Now Dr. Harsha is, and the primary expenditure limit has gone to him, and he has also taken great efforts. But this time, 17, 18, I think Mr. Sumandran was, and we raised it. The committee also published a report. And what do you think happened? Suddenly, the next years, they have projected it quite closely. Like, that's what you see after 2018, after it was highlighted by Verity and the committee. 2019, 2021, and 22-23 also, it was quite well projected because there was no reason to hold it. This is, again, something accountants and auditors can do because this is something I'm sure you do for companies, where you look at the expenditure and say, does it make sense? And it does not. And highlighting it and simply bringing light to that fact will result in things happening properly. Because when you underestimate, the problem is bigger than this, because when you underestimate interest cost, you can promise a lot more because you're underestimating expenditure. And then you realize, oh, my interest cost is too high, I'm going to cut down on everything that I promised. So it's important to get your expenditure right, because that's how you know how much money you have for everything else. And the last case study I'm going to do is on the IMF tracker. This is something that I personally work on. This is something that also stems from my interest in accounting and audit per se. And basically just auditing the IMF program itself. Because this is something that we did in the past, the new updates are coming up. What we said was, look here, you are not following the IMF program very well. Because 16 of them is not met. And most of them are on financial management and financial transparency, which is, again, a very accounting audit-related thing that Sri Lanka is failing. So this is where my point that I said earlier, the government needs the help of the private sector, and especially the auditing fraternity, because that's where we're failing the most. Financial management and financial transparency is an area we're failing the most, partly because nobody really questions it as well. and the most recent case study that I'm going to bring in is from the recent review, where if you look at the highlighted segment, it basically says that we expect to complete and publish audited 2023 financial statements of all 52 major state-owned enterprises by end June 2024. That's basically last month. So this is basically saying that we will publish all of the annual reports from the state-owned enterprises audited by the end of June. And what do you think happened is by July, that is 1 month later, the first thing you notice is that there is an unaudited financial statement, the first row. The problem here stems on a lot of places, right? Like I think obviously this is where the accounting firms and the accountants need step up. And I know personally a lot of socially aware accountants who question all of this, but I think we need a platform and maybe a more open and focused approach. Because this is a place where the government and the accountants can join hands together and help and publish all of the audited financial statements, because unaudited financial statements, as limited as my accounting knowledge is very poorly done. So I'm going to close because I can see the time here. There's this saying that says, you know, the price of democracy is eternal vigilance. And without eternal vigilance, you are going to suspend democracy, you are going to suspend governance. I heard in the previous panel, you know, ESG, we focus on the E, we focus on environment. I'm going to take a little bit away and say we focus on governance also. The G is very, very important. And I personally believe the reason for our crisis is not a debt crisis, it's not a social crisis. These are all symptoms. It's like saying a person who died in the accident, he died because of overbleeding. Yes, that's a symptom. That's not the cause. The cause is the accident. And the accident stems from governance. And the governance, a simple example is that when you don't hold people accountable, there's going to be room to be played. Accountability comes when fraternities like the accountants, fraternity think tanks like Verite step up and say, there is a problem, we see this, and we are holding you accountable. And when you come out and hold people accountable, you need to be transparent, and you have to advocate for transparency. And transparency and accountability is almost two sides of the same coin. The greater the transparency, the greater the accountability, because it enables all of us to hold the government accountable. So let me sort of close with one thing to say. If you took out anything from my presentation today, is that accountants need to step a bit more and also help us, because I think the government needs help, as you can see here. Think tanks are filled with economists who like to believe that they're high and mighty. I am personally in that bias also. But we need someone who can get their hands dirty, look into the nitty-gritties, look into the numbers, and say, where do we optimize? Because we cannot increase revenue anymore. We cannot increase taxes. It's going to be socially unacceptable if I say, oh, go and increase VAT to 20% or corporate income tax to 40%. So then the question is, to maintain good fiscal discipline has to come from expenditure. And the first step in optimizing expenditure is through transparency, and transparency alone. Thank you.
Thank you very much. Thank you very much, Raj. That's a very interesting presentation on government expenditure, managing government expenditure with accountability and transparency. So now let's move to the panel discussion. So we have three panelists in addition to our two speakers today. Chanda Gunawardana, he's the Director CEO of Dankoto Porcelain PLC. Mr. Asim Bhagava, Senior Vice President Finance of Lanka IOC, and Sajivani Amarasinghe, CFO of Lanka Tiles. Right. Asim, I would like to ask from you. Since you are representing a very important sector in our economy, can you explain how the fluctuations in fuel prices can affect cost management in your industry?
Yeah, thank you, Ruchira. Coming from petroleum industry, the first thing I would like to start with is we are a public listed company, and the main aim is always to maximize the return to stakeholders. While we say that, at the same time, the ensuring good, healthy earnings is equally important for us to ensure that. And for that, in the changing business environment as on date, the petrol and diesel prices are being fixed by the ministry. So having said that, there is a IMF formula in place, which is promulgated, which consists of several parameters which have to be followed, and accordingly the pricing is fixed on the start of every month by the ministry. Such kind of pricing need not represent the exact cost that exact procurement cost and the exact element of all the costs that that form part of our final pricing. So what I wish to conclude is that the pricing does not primarily represent our pricing. So it puts pressure on the margin if the pricing is not as per the procurements. So actually, this leads to the actual control over the costs that we have to do, the managing of the costs. And when we talk of costs, the primary cost is the procurement, because it is the suppliers who are going to supply the product at a particular price. We, as a company, always go for tendering to give opportunities to the players across the globe. And whatever pricing we receive in the tenders, in order to manage that price, because that forms the 90 to 95% of the total cost of the product, we try to achieve the best possible rates. It is on each player, since the market now has more than one private players, because it is now open as a competition. So we always try to strive for the best possible, lowest possible cost from the market, and that involves ensuring the correct pricing period, because we all know that because of the geopolitical reasons, the demand and supply factors across the globe, the pricing of oil products fluctuates, and sometimes to a very large extent in a very short period. So in order to ensure that we are able to get the most competitive prices, we have to make a very, the most possible accurate, accurately we have to assess the change in the pricing that is going to happen or that may happen in a particular period of time. So the pricing period, may it be 15 days or 30 days from the date of when we are finalizing the procurement, forms the very basis. It is a very important element to determine, to finalize the costs. And second part is the premium element that the suppliers are going to charge. So these two are the primary factors we have to finalize at the time of entering into the contract. Then the second part of the cost is, the important part is the LC charges and the LC confirmation cost. Because still, as many of our speakers have already highlighted that, and in the morning also the governor was mentioning that still the country rating stands at restricted default or selective default levels. Because of that, so in order to circumvent that kind of risk which is perceived by the suppliers that the country still has, they are still asking for confirmation of those letter of credits. So when that cost comes into play, it is a very hefty expenditure, I must mention here. Then is the LC opening charges. They also play a very major role. So these two costs are the combined together as the bank charges are very, very significant as on date because of the country risk associated. So all these costs apply too much pressure on the margins, and when the retail selling price is, there is a ceiling beyond which the oil companies, the private players, and as well as, I would say, the national oil company are not allowed to go beyond in selling the product, then the margin levels are very much squeezed. So this is the importance of cost control that comes into picture now, that as much as we are able to bring down through the negotiations with the suppliers as well as the banks, we would be able to achieve a lower level of cost and ensure a good margin so that we are able to grow as well as sustain in the business. Thank you.
Thank you, Asim. I will come back to cost management strategies a little later. Now from Channa. Now, Dankoto Porcelain we have seen has achieved significant growth in the recent past years. So what kind of strategies, cost management strategies that you employ in your organization while achieving this sustainable growth?
First, Professor Lakshman, thank you very much for inviting me. So when we look at the topic that is available, cost management in a growth era when the organization is growing, I think first factor that one needs to consider is mindset for a growth will be fairly different for a mindset for a cost management. Which you might call it mindset, you might call it the way that we work, you might call it the culture. The way that you work will be very different when you want to grow the organization rapidly compared to when you look at the cost element and try to reduce them. So you might have that mindset in your mind, but people will see it on everyday basis. So at Dankodo Porcelain, we do sell about 60% of our products globally. As an example, let's say one of my international marketing managers would come to me and say, Chan, I would like to go to Dubai again to meet the customer. So when he asked me, I'm planning to go to Dubai, I need to go to Dubai again to meet the customer, maybe we are going 2 months ago, what am I going to tell him? If I start the discussion with what's the air ticket price and how much it will cost for the overall trip, I'm trying to set up a mindset for the organization on the cost management side of it. Or if I'm trying to tell him, okay, great, please go there, and can you spend 1 extra day to meet some other customers, then I'm going to set up a mindset for the organization, culture for the organization, for the growth. So I think first thing that we need to do right is to identify and understand there are 2 different mindsets available. And decide what is the right mindset for the organization given your present position. Given the position of the organization. So if you look at the last 3 years of Dankodo, where we have grown rapidly in terms of sales and profitability, I think we were mostly on the growth mindset. We have decided internally, let's not go for the cost management that will disturb or impact the people at all. Because we wanted to encourage the mindset for a growth. So I think each and every organization will have to take that call first. Now, next year, if the markets are down, if the Sri Lankan market is not really behaving in a way that will help products like Dankodo Porcelain, if the global markets are down, maybe we will try to shift from the growth mindset to the cost mindset more. So that's the first thing that we needed to sort it out. However, the answer is the cost mindset or the cost management techniques that will not disturb the growth of the organization. Cost management techniques that will not disturb the people of the organization are the biggest elements in terms of the reduction of cost. So in last 3-4 years, we have never done any of the traditional cost-cutting exercises, including transport and all that. Nothing, we have not touched any of those. But we have looked at and we have implemented some of the management accounting techniques very strongly, including activity-based costing and the business process reengineering. Those are the 2 things that had given a substantial impact in the cost management angle and the growth angle as well. So we had gone to the extreme extent of the customer-wise and product-wise profitability to product-wise profitability based on the activity-based costing, and to look at how can we grow the capacity by 25% and let the cost increase by 10%. I mean, no one wants to reduce costs, everyone wants to increase profits. So I think that mindset and believing that we need to look at the big ticket items is a starting point that has worked very well for Dankodo. I was at one of the discussions on a different organization as a kind of since I was known to them, medium-sized organization. So they were presenting a cost management techniques which started with some of very minor items. But when you look at their purchasing side, their concentration was much less. So that's the first thing that we need to get it right. Now, as an organization, internally, my biggest cost elements were raw material. We have seen many presentations about the great presentation just before us on the Sri Lankan economy. So Dankodo Porcelain being a Sri Lankan company based in Sri Lanka, owned by Sri Lankans, all that. But my clay comes from 3 different overseas countries. So I import matty to make the plates that I sell in 50 different countries. So that's the first element that we have worked on. We have been looking at where we can buy the best quality clay. Is it available in Sri Lanka? Can we kind of process it and take it? Or where else? Because I use part of my clay from New Zealand, which helps me to maintain the quality standard that I want. But we have challenged that traditional thinking and started to argue, can we buy clay cheaper? That impact on the bottom line will be much higher than many other cost management techniques that I can implement and upset a lot of people. Broadly speaking, I think one of the best cost management techniques is to spend a little bit more money on the people. Well, when you do spend a little bit more money on the people, immediately the cost will go up. But if you can set that growth mindset, if you can give them that vision for the organization to grow, for the capacity to be improved, I think automatically you will be having a lot of cost efficiencies coming in. So on the other side, things that we work, I mean, if you do come to the factory, you will see we have very low on kilns where we fire all the products at 1,300 Celsius. So I use about 250,000 kilos of gas every month. So you will know how the gas prices went up in last 3 years, partly due to exchange, partly due to the price escalations. But again, we were very careful in 2 things. One is, whenever gas price goes up, internally we have agreed, let's not talk about the things that we can't control much. So always, instead of doing the PowerPoint presentation of what's the total cost increase because of the gas prices increase or whatever, we're not spend time on that. We've done 2 things. So we have said always internally within the Ankudu Porcelain PLC, every 3 years a tsunami will come. Every 3 years a COVID will come. We got to be ready with it. Therefore, sometimes we used to say it might not be a COVID that we have seen, it might be a smaller one. So when there's a substantial price increase in the raw material, it's a small COVID for us. That's a huge learning. And how do we look at the alternate methods of sourcing? And how do we use the alternate energy sources? If not, where else we can go and play to ensure the profit goes up with the increased cost. So that's where we work on the premium quality of the product. So if you look at my products, not for the Sri Lankan market, for the global market. So I sell my 3 largest markets are US, India, and Dubai, where we try to see how do we go for a new product range where I can charge a premium price. And how much sales will I bring in from the new product range? How much is the addition to my profitability? And what percentage of cost increase I'll be able to cover from that? Is it 80%? And what are you going to do for the balance 20%? So that's the kind of the thinking, then that's the kind of a very different thinking that we have been trying to kind of push within the organization. Of course, the techniques like business process re-engineering, ABC, activity-based costing has helped us internally a lot. So just to kind of end my comments on the overall topic, what is the culture that you are going to set for the organization? Sometimes it might be worthwhile not to work on the minor cost elements because that will disturb the growth for the organization. And when you push for the growth for the organization, you know, the additional profit benefit that you're going to get it, out of that might be spent or wasted because we did not manage the minor cost. That might be fine. So in the situation where, in the earlier example, if I may go back to the earlier example, when one of my international marketing team members wants to go to Dubai, if I started to ask about the cost, the hotel cost, air ticket and all that, next time if he needs to go to Germany, he might not even come to me. We might miss a bigger opportunity there. So therefore, that setting that mindset, setting that culture for growth and look at the big ticket items where there is no negative impact for the organization, but the impact for the bottom line is fairly substantial. So that's the journey that we have kind of taken in last 3 years. Things might change with the economic conditions, things might change, then we might have to change our behavior, but that has been the journey for last 3-4 years where I have been there. Thank you.
Thanks, Channa. I will come back to you on automation and AI a little later. Now, Sanjeevani, I want to just check something from you. Now, Channa has mentioned in his commentary that he believes that not cutting cost on employees, that is something that he is doing basically as a cost management. I mean, he doesn't believe that as a cost management strategy, cutting cost on employees. Do you agree with that? And also, can you share an example of a cost-saving strategy in your organization?
Yes. Yes, thank you, Ruchira. Yes, actually, I agree with what Channa said about increasing profitability and eliminating the traditional cost-cutting procedures, because even in Lanka Tires, what we look at is a more holistic view of the total company, where we can increase profitability through our margins. So when we are growing, especially we are focusing on USA market at the moment, and where the value-added products, from the value-added products, we can gain more margins, because in Sri Lanka, in the manufacturing context, if we take the expenses, most of the expenses, nearly 70% of the manufacturing cost of the companies are out of our control, because most of the manufacturing cost, the main part for the tile manufacturing is the energy cost, because raw material, the clay is sourced internally from locally, and the energy cost is the highest cost for tiles. So controlling that is beyond our control, and electricity cost, all these energy costs are beyond our control. So trying to compete with products from India, China is beyond our control. So that's why we also focus more on growing the company, especially with the export market. So apart from that, yes, developing employees and also empowering employees to make decisions and to solve problems is also very important. So we are giving more allocations on employee training, especially cross-training, where the same function can be completed by 2 different employees. So that is where we try to increase innovation, and through that we try to minimize our cost as a total company point of view.
Thank you, Sanjeevani. Raman sir, just a quick question from you. In your presentation, you have mentioned about the value chain model in cost management. So can you please explain to the audience how societal costing can be integrated into the value chain model?
Yeah, before I answer you, my first clarification or setting the context is important. One big misnomer is cost management is always equated to cost reduction in a very general language of expression. We have been trying from the institute as well as from the professional bodies angle, cost management is not equal to cost cutting. Cost cutting is one tool of cost management. There could be situations where you need to spend more for higher value creation. That is also cost management. You need to increase the cost for increasing the value addition or growth. So cost management as a framework should never be equated to short-term cost cutting and tactical cost cutting for gaining few dollars on some of the major expense heads. This is one major point of clarification which Mr. Channa also has very nicely emphasized. This difference in the 2 topics of the framework should always be kept in mind. The reason is, the moment you speak of cost management, you get a taboo in your mind. That the moment you speak of cost management, we are trying to talk about cost cutting. It is not so. So now in the context of cost management, one of the important tools is not to understand the cost, but more in terms of value. The typical value chain as a concept is, in any field, You start with the raw material, and that raw material ends as a product in the hands of the customer. At each stage, it can be in one company or in multiple companies. At each company, some sort of value is added at each stage. And finally, the product is delivered to the customer. One company, if it does everything in the value chain, then it a very comprehensive company. Like for example, one company can have iron mines, or like in the case of oil, it can have it can have the fields. I also extract. I also distill. Then I also crack it and make multiple products. And I also market every damn thing till I sell it to the customer in a petrol bunk, the lubricants as well as the petrol, or to the major bulk customers. If everything is done by one company, they are in the full value chain. But if you as a company, you are operating, let us say, in one part of the value chain, like for example, I am a small dealer, I need to buy certain products from Lanka IOC and sell it to the customer. I am in last phase of the value chain. What is the problem in last phase of value chain? Structurally, as a structural cost management, not as a tactical or that month's cost reduction. I am not talking that. As a structural cost planner, I know I will be always impacted by the buying price. So my end customer is also putting pressure on my price because the government is regulating. I don't have any influence on my procurement price. So I am operating on a very narrow band of value chain by which my margins are squeezed. Understanding your position in the value chain and organizing your cost planning strategically, structurally, and not thinking on that month's travel, on that month's spending on some purchase of stationery. That is all tactical cost cutting. But structurally thinking at that level and taking leadership action as to how you are going to plan and organize your value chain positioning is called as a value chain based cost management.
Thank you, sir. Raj, very quickly again, how do you foresee the economic trends impacting the cost management strategies of the government in the next 5 years?
So on the government side of things, at least economic trend-wise, interest cost, again, is the biggest impact that the government can place on you. At least with elections, of course, we saw interest costs going up, and there was this whole thing because of the risk premium. But even for the IMF program and even for debt sustainability, we will see interest costs coming down. The central bank has highlighted it. So that might be a bit of a saving there because the government really has to bring its yields down, and it's trying, the central bank is also hinting at bringing its yields down. The only problem that you have is the US treasuries are also going up, and that might limit its impact, but the general trend is you will see after elections, interest rates dropping. The second thing is on the private sector credit growing. And I think the government has taken plans to increase private sector growth, so you will see the recovery part coming in. That is also coupled with the economy recovering in sense. So like we had 6 quarters of consecutive contraction or recession, and now we have 3 quarters of growth. And that growth is being stemmed mainly from the industries recovering, because the service sector was not too impacted by the crisis. It was the industry that was affected the most. So you see the industry is recovering. And that recovery will often mean that there is growth, there is more opportunities coming in. The last thing that might help with the cost management side of things is FDI rollout. And I think the IMF has also focused its attention this time on FDIs coming in. Because all this time, the reviews are more focused on fiscal discipline and improving that. The second review this time also focuses a little bit on growth. So female labor force participation improving, so creating new jobs and also bringing in FDIs. So I think those are the new trends that will really impact your costs.
Thank you, Raj. Thank you very much. Sajuni, one last question to you. So now you have mentioned that we need to be competitive in terms of cost control when it comes to other competitors from India and China. So my question to you this time is to see whether you compromise on quality control and maintenance in order to achieve cost optimization or in order to be competitive with these competitors?
No, I don't think that should be the, sorry.
No, actually the question is for Sajivani, sorry.
Yes, Ruchira.
No question, I'll repeat the question, Sajivani. Just wanted to check with you whether you compromise on cost management, in the sense quality control and maintenance cost in order to be competitive when it comes to other competitors, big time competitors like India and China.
Yes. Now we have separate production teams projects that we have given for each separate department. So based on these projects, we are gaining certain cost management initiatives. Like now, when we say that our main cost driver is energy cost, now we have given projects like where the kiln is heated up to about 1,200 Celsius. So the heat generated from the kiln can be transferred to the spray dryers and vertical dryers. So these kind of innovative ideas from the teams can really contribute to reduce the cost of the company. So the total productive maintenance and preventive or predictive maintenance are some of the areas where we try to improve the productivity of the company and try to be more competitive in the markets. But it depends on the market that we are going to really target, and also depends on even the local markets, what are the customer touch points. So based on that, we have to focus our strategies. And overall company-wise, being a manufacturing company, I think the process re-engineering and also improving the employees, like our workers, and getting more innovative solutions will be the best solutions.
Okay, thank you. So before we wind up, one last question to both Channa and Asim. So I'll start with Channa. Can you share a cost-saving initiative that your organization employs in order to be competitive?
So I think we have 6 minutes to finish and ensure that no one gets go to the Shangri-La traffic. So I'll quickly finish. I will quickly give my comment. So one of the two critical examples that I can share, one is, so again, we have a large kilns. So there's a certain time, all the plates that you eat on, I mean, some of these plates are there in a kiln for 13 hours at 1,300 Celsius. So what we realize is, if we can make that 13 hours less, that's where the lot of money is. So that's one of the big projects that is successful. But when it comes to the reality, I mean, we can have a nice model of it, but when it comes to reality for people to do that, there should be the culture set right. That's the point that I tried to highlight before. So since I want to kind of emphasize on that, and this is a classic example because Ruchira, so the situation where the product is inside the kiln for 13 hours, we decided to reduce the number of hours. Based on the technical evaluation, that's a very difficult task. But how we got it done was we created an internal COVID. That's what we call it. But we created an internal pressure. That's not a genuine actual pressure, one we created. So we told all the production teams in that month, this happened 2 years ago, we said all the orders that were supposed to ship in next 2 months, we said customers are asking it in 1 month's time. Can you find a way to do it? That was the beginning of the discussion. I'm not saying that within 1 month they found everything, but that pressure created worked very well. So that's one of the major cost-cutting exercises that we have done. Second part was on, I briefly mentioned before, how can we use the clay from Asian region or from our own country instead of paying money for New Zealand. So those are the two big elements that we have done. So you have 2 minutes to finish.
Asim.
Yeah, Ruchira, in our case, as I earlier mentioned, the major cost control and cost even reduction areas are the procurement costs mainly. And the procurement cost is one of them is from the supplier side. Now, apart from that, once the procurement is done, whenever it is done, there's a date on which the discharge of the product is happening, and that date we actually book the total cost in our books. And then comes a date when the actual payment is to be made. So everything is happening in dollars, and it's a huge amount of dollars that are involved. Maybe one consignment going into around 25 to 30 million dollars. So what I want to highlight here is the exchange risk that we have to face, because it is a very important part of our total cost. If we suffer an exchange loss, it can go into huge, many millions in LKR. So in order to control that, we have to find out various ways and means to maybe get into some forwards with the banks, because this is one way that we are able to, although it has a flip side also, but getting into a hedging kind of setup with the banks, we are able to at least minimize the loss. Because maybe at most of the times we are very much sure that at least the loss could not happen. Though if it goes on the other side, we may lose the money as well, because we may lose the gain, not the money, the gain part of it. So this is one of the techniques. Another aspect, when I talked of LC charges and LC confirmation charges, while we are negotiating with the banks for reduction of those charges, at the same time, we take up with the suppliers also, and we are able to convince few of the suppliers now, with the improvement in the country situation, that we can go beyond the requirement of LCA per se. Because we are able to convince big suppliers, some of them, that we can make the payment on open credit basis also, which eliminates the requirement of going for LC altogether. So that is one of the areas we have been successful in, eliminating either the LC requirement in totality or at least the confirmation, despite the country situation that we are in. Still the ratings are yet to be changed. Thank you.
Thank you, Asim. So, ladies and gentlemen, this brings the end of our session and also end of the proceedings for the day. I would like to express my gratitude for all the speakers and also for the panelists for sharing the expertise and knowledge with our audience. So to conclude, let me now invite my co-chair, Mr. Asanga Vimalaratne, to deliver the vote of thanks.
Thank you, Ruchira. As we conclude this insightful third technical session of the CMA National Management Accounting Conference, it is my honor to deliver closing remarks. And let me assure you, it will take less than 5 minutes. The theme of the session, managing cost for dynamic growth, has been thoroughly explored through our speakers and panelists' perspective and expertise. First, Mr. Raman, past president of SAFA, provided with an excellent overview of managing cost for growth strategy with sustainability. His emphasis on integrating sustainability practices into our growth strategy is not just timely, but essential. Following this, Mr. Raj Prabhu delivered an enlightening talk on optimizing government expenditure and managing fiscal risk with transparency and accountability. His discussion highlights the importance of transparency and accountable fiscal management. As finance professionals, we have a crucial role in ensuring expenditure, whether it is capital expenditure or operational expenditure. Those expenditures are optimized, risks are managed effectively, and that we uphold highest standards of transparency and accountability. During the panel discussions, we were privileged to hear from Mr. Asim Bhargava, Senior Vice President, Finance, IOC Sri Lanka, Mr. Channa Gunawardana, CEO of Dankatua Porcelain PLC, and Ms. Sajivani Amarasinghe, CFO of Lanka Tiles PLC. Thank you once again to all our speakers and panelists and our session chairman, Mr. Ruchira Pereira, for their valuable contribution, and thank to you all for your active participation and engagement. And finally, together we can pave the way for a prosperous and sustainable future. Thank you.
Thank you to our co-chair. We'd like to give our thanks to you in a form that you can take home with you and look at from time to time. So I'd like to invite Professor Lakshman R. Ratavala to present some tokens of appreciation. We begin with one of our session chairmen, Mr. Ruchira Pereira. And his co-chair, Mr. Asanga Vimalaratna. Mr. A.N. Raman. Mr. Raj Prabhu Rajakulendran. Mr. Asim Bhargava. Ms. Sanjeevani Amarasinghe. I beg your pardon, Ms. Sajeevani Amarasinghe. And Mr. Channa Gunawardana. I'd like to invite Mr. Hennayak Bandara on stage for the photograph. As the photograph is being taken, I'd like to take a moment to recognize our sponsors, platinum sponsors, Lanka IOC PLC and Pearson View, gold sponsors, Sanasa Life Insurance Company PLC, OTR Engineered Solutions Lanka, Diesel and Motor Engineering PLC, Haycab PLC and SLT Mobitel, the silver sponsors, Salinco Life Insurance Limited, SoftLogic Life Insurance PLC, National Savings Bank, AJ Medichem International Private Limited, Built Element Limited, and Akbar Brothers Group, the print media partner, Vijay Newspapers Limited, and also People's Bank, our sponsor.